Hello and welcome to this fifth annual Sigma report on resilience, restoring resilience. I'm very pleased to be joined by the managing editor of the Sigma series, who is also our group chief economist, Dr. Jerome Haegeli. Jerome, nice to talk to you today.
Great to be with you.
Thank you. And resilience really a core benefit of the insurance industry. Clearly, it's at the heart of Swiss Re's sort of vision. We make the world more resilient. Tell us just a little bit now what it means for society and what it means from an insurance perspective, just the baseline.
Economic resilience, we define it as the ability to withstand adverse economic shocks. So if you have a shock, how quickly and how well do you bounce back? That's how we define economic resilience. What we do in our 50th anniversary for the resilience indices, we look at the key perils, Nat Cat, mortality and health, and we add crop insurance resilience as well as connective storms. Crop insurance, why do we add it? We add it because of food insecurity, because of the tectonic shifts that we are seeing over the last 2 years or over the last few years with the cost of living crisis.
Okay, and then just looking at the macroeconomic picture, obviously there's a lot going on out there. It's extremely volatile. What does that mean for the global economy? What is resilience to the global economy, and what are the dynamics of that right now?
In terms of the economic resilience of the global economy, and we also take stock basically with our 50th anniversary Sigma. The way we analyze economic resilience, both structural as well as cyclical factors, and cyclical factors are fiscal and monetary policies. The good news is economic resilience for key economies, but also for the global economy, it has improved over the last year. Since 2008, since the global financial crisis, however, and that's the other side of the coin, and that's also why we shouldn't be complacent at all. Economic resilience is still weaker, and actually by a considerable amount. So there definitely is more work to do in order to replenish growth, which means at the end of the day, economies as well as households, they are very much exposed by economic shocks, whether they're expected or unexpected.
Okay, and then obviously, so we've now got the 5-year series that helps us look through that. Households and and the economy, they're very much important to the insurance industry. So what does this mean for the insurance industry?
Well, for the insurance industry, having good transparency, having good data of where the protection gaps are and how the protection gaps are developing, so how the uninsured part of economic losses, how they are developing, I think that's crucial for the insurance industry to do its work at the best, meaning transferring risk. We need to have data, we need to analyze the situation, and I think our protection gap indices, resilience work helps a lot. It's the first step, having good data.
Okay, and then how do you see insurance resilience developing over the next, in the next years, in the next sort of short to mid-term?
Well, we are seeing actually that on the insurance resilience front, so the ability of the insurance industry to transfer the risks, so the insurance take-up as well, it has improved, and that's definitely good news. There is progress being made. This being said, while 10 years ago the protection gap was about 46%, roughly speaking, across the key perils on average. Now it's 43%. That's an improvement. However, more can be done. More can be done also if you look at protection gap figures. Protection gap figures in absolute terms is $1.8 trillion, according to our latest Sigma report. And $1.8 trillion, that's a record high. Yeah. That's an increase from $1.5 trillion if you would have had crop insurance indices already in last year's Sigmas. So a big uptake, and the way we analyze protection gap estimates, they are growing roughly in line with nominal GDP, 3 to 5%. So definitely, while progress has been made on the insurance resilience front, more needs to be done.
Okay. Okay. Now, you were at a meeting recently with the ECB and IOPA talking about the role of insurance in all of this. Tell us a little bit about that and what the role of insurance really is.
Oh, thanks. That's super important in terms of, and I highly welcome that there has been more work done by IOPA and others in terms of understanding and how protection gaps are developing and also what we can do. And I think there's a lot that we can do. We can do a lot in terms of improving and also harnessing the resilience dividends. Resilience dividends, as we cover it in the Sigma report, we look at two resilience dividends. First, we can invest in loss prevention, and let's not forget, insurance industry, we are also long-term investors. So how we deploy our assets also can make a lot of difference. And we can deploy our assets not just to make a difference, but also with a lot of economic benefits. Let me give you one example. $1 of investments in sustainable infrastructure, it yields about $4. And meaning infrastructure investment, it creates jobs, but it also contributes towards the goal of the Paris Agreement, for example. This is just one example. Another example, another case that I made with IOPA and the ECB in the workshop is that we need to have more assets. We need to have more private capital market assets. We need to lower the barriers for the investments, because there's no way that we can finance a net zero economy without having more capital markets deepening. Another point I think it's important on the resilience dividend front is not just loss prevention, but also the transferring of the risk. So insurance coverage and insurance take-up. And there I think innovation, data, and public-private partnerships are super crucial.
Yeah, so everybody in this, all the stakeholders in the resilience discussion can take action on this. Jerome, thank you very much indeed for joining me today, and thank you also for watching. Restoring Resilience is available on our website, as is the series of the previous resilience reports. Please go and have a look at them there, alongside some other collateral that we've developed. Other than that, thank you very much for watching, and bye for now.